Hey, what's up, stock compounders? Brad here. So it has been a long time since I've made a video. It's been over a week. I've been traveling through the Midwest with family, and even though I haven't had a chance to make a video in a while, I've been doing some really good thinking. So you will all be the beneficiaries of that soon enough. So anyway, today I wanted to do my weekly Q&A. We had quite a few questions today. Looks like somewhere around 36. I don't know if I'll get to all of them, but let's jump in to what we have. The first question, how do you feel about making a portfolio of companies that are capital allocators and shareholder friendly? For example, Berkshire, Pershing Square, Interactive, Brookfield Asset Management, TDY Markel, essentially outsourcing your investment decisions to the pros. So I think that's a pretty sound approach. Identify some of the best capital allocators in the world and let them compound your money for you. So I don't have too much of an issue with that. The only thing I'd want to really make sure of is that the track record within the last, ideally 20 years, kind of since the dot-com bubble. Okay, 21 years maybe. Because I think it's really important to have at least two major corrections in the stock market represented when you're looking at track records. And then paired with that, managers who are running smaller amounts of capital is ideal. I'd say closer to that 100 million cutoff that requires you to file a 13F, because when you get into some of the larger AUMs that fund managers are running, like Berkshire Hathaway, for example, it really does kind of cut back the number of opportunities, because obviously they can only select from those larger companies that are going to move the needle for them. So, there's kind of a trade-off there that is really up to the individual to decide, what do you want to optimize for. So, but again, I think that's kind of the direction I'm moving, is identifying these great capital allocators who have a lot of skin in the game, right? They also have a high equity position, so they're inclined to make decisions that will kind of transfer the benefits of these businesses to shareholders because they themselves are shareholders. So great question, Nick. Hey, Brad, do you know about the Chandler Brothers that compounded 10 million at a rate of 30% for 20 years, ending up with 5 billion? How to clone the ideas of Chandler from being a shameless cloner. So I have not heard, I don't think, about the Chandler Brothers. That's something I'm going to have to dig into. If you guys have any more information about them, let me know. 20 years, I mean, it's a pretty good chunk of time to be generating a rate of return that high. Obviously started out with fairly small sums in the fund management business. But I am intrigued, kind of reading some of those figures. So thanks for that tip. Is Micron a long-term investment for Monish, like Alibaba, or is it more akin to his former investment philosophy? So I believe Monish has said this a few times in talks at business schools. He does not see Micron as a long-term compounder. He bought it kind of before he made that shift in investment framework from 50-cent dollar bills to 100 baggers. So I don't think Pabrai is going to be holding Micron for more than, say, another 5 years. It was a discounted pie, is my understanding. Certainly it has tailwinds, right? But I think, it being such a large market cap already probably would have discouraged Pabrai from buying into it under this new framework. So that's my take on Micron. Any thoughts on Michael Burry's new short positions on the 20-year Treasury bond in preparation for inflation? Or any thoughts on inflation? So I don't really spend much time thinking about inflation for my investment portfolio. I noted one of my buddies on YouTube, Karan Gurnani, he has a YouTube channel. He was particularly intrigued by this short position from Michael Burry. So if he hasn't made a video about it already, I'm sure he will shortly, and you might just give him a nudge because anything he has to say on this particular position is going to be more valuable than any thoughts that I have on it. So check him out. I really appreciate your work. Absolutely. I'm new to investing and have learned a lot from you and your co-conspirators at PunchCard. Yes, for any of you who have not subscribed to PunchCard Investing, do that. Okay, we do a video every week on a variety of topics related to investing, and there's some really smart guys that I'm collaborating with over there. What are your thoughts on JD.com? Despite being somewhat of a competitor to Alibaba, they've for now seemed to have escaped the wrath of the Chinese government. Do you feel this company has a future? So I don't know enough about JD.com to really express an opinion on it. I would look at Value Investors Club to see if there's a recent write-up on JD.com. I would look at Corner of Berkshire and Fairfax to see if there's a thread on JD.com. Those are some of the resources that I go to first. And what I'm using more and more is Twitter. Just typing, in Twitter search $JD and seeing who's talking about it on Twitter. I've found that to be quite valuable. Jake, what do you think about splitting a portfolio 50% cigar butts and 50% compounders or high quality businesses, constantly turning over the cigar butts and never selling the compounders? Yeah, I get why that's a compelling approach to be able to kind of dip into both of those baskets. One of the things Pabrai is really big on is focus, okay? The things we focus on, we tend to find. And if we split our attention up in too many ways, it's going to be difficult to optimize in any one approach. So that's something I've really taken to heart. For that reason, this probably isn't an approach that I would use. I'm solely focused on these kind of long-term compounders, these high-quality businesses, finding them before everyone else sees them as these long-term compounders, so I can get a reasonable buy-in price. But that's my take on that. I think it's really important to focus, and you're going to get what you're focused on. Are we getting too biased with Monish Pabrai as he is the most visible compared to others with his regular videos? Of course he is great, but just thinking critically, is that making us biased against overlooking some of the top bets, other great investors, Klarman, Miller, Einhorn? So each quarter I am looking at all of these great investors and what companies they're buying. There wasn't a whole lot of activity in Q1 of 2021. Obviously I made a video about it a couple weeks ago. But yeah, I mean, because Monish Pabrai is putting out so much content, it's a lot easier to get into his head and kind of see the market through his investment framework, as compared to some of these other great investors who aren't putting out content at the same scale as he is. But yeah, it's an interesting question. I think it's important to also try to get in Pabrai's mind in terms of figuring out what his biases are, and using that to frame the things that he's doing, so that we don't fall into the trap of seeing him as the guru and kind of going in with blinders on. I think it's really important to keep in mind, we all have biases. So taking a step back through Pabrai's eyes, through his investment perspective, and asking ourselves, all right, how has this guy's history in the markets shaped his biases, and taking that in. So I wish that a bunch of these other great investors were doing multiple talks at business schools every month. That would be awesome. But we have to kind of take them as they come. Besides investing with your own account and growing that, how would one go about creating a career out of investing or work for an established investor? So I don't know that this is widely known. Certainly Pabrai has mentioned it recently, but he actually wrote a letter to Warren Buffett. I think it was back in 1999, asking to work for Buffett for free. Okay. And of course, Buffett, he likes to kind of do his own thing and work alone. That's really how he's found to be the best way for him. But Gary Vee has a lot of great information on this. Gary Vee basically said if he were starting from scratch, he would identify, the people that he most admired and offer to work for them for free. And the best way, I think, to work for someone for free, you got to realize these really successful people, their time is the most valuable thing. Okay. So just offering to work for them for free isn't necessarily going to really get them excited and compelled to take someone on. I think that the key there is to have developed a skill set that can actually benefit that person, who probably has, a bunch of help, right? Kind of banging the door down and doesn't need more money, right? They're in a great position financially. So what is it that would actually benefit them? I think it's really important to really kind of gut check. What is that? And can you develop that skill set to really help them? And there's always something. Everyone has something that would make their lives better, to partner with someone who has that specific skill set. It's just a matter of figuring out what that is and if it's actually feasible for you to develop that skill set. But Pabrai has also talked about this, making a career out of investing. The best way to make a career out of investing is to develop a phenomenal track record in investing. So actually doing it, investing and showing that you can generate superior returns. Warren Buffett said something like, you can be a leper on a boat in the middle of the Pacific Ocean. Okay, if you've generated outstanding returns as compared to the market, people will find you. Okay, they will throw their money at you. So that's really all you need to do when it comes to creating a career out of investing, is show people that you're a great investor. Okay, and that's easier said than done. But that's really where the rubber meets the road, as far as I'm concerned. If you found a stock you feel like you have a true insight on, and it is undervalued, but it isn't in any super investor's portfolio, would you invest in it? That's a great question. I'm inclined to say no. Okay, and part of the reason for that is there's so many things to consider when making an investment. Okay, and this bowling with bumpers, right? This only looking at companies that other great investors have already bought, have kind of kicked the tires on. It's just an exquisite shortcut to avoiding these zeros in the portfolio. Okay, perhaps someday I'll say yes, I would invest in it anyway, even if no other great investor had invested in it. But I think some of that is ego, just wanting to say, hey, I found this company. Okay, Nobody else I know invested in this company. But for me, this game isn't about my ego. It's about getting to the promised land. And so if I can just remind myself of that, there's no extra credit for coming up with original ideas in investing. So, and I have all kinds of biases, right? I didn't, I'm not a serial entrepreneur. I didn't start a bunch of businesses early in my life. So there's a lot of investors who are always going to be better than me, okay? Because they have those core experiences as business people. So why wouldn't I let them generate that kind of initial list of companies to look at for me? I think the only reason to do anything other than that is ego, and this isn't a game that I'm in for my ego. So it's a great question, though. Hey, Brad, how do you identify the KPIs, the most important factors that will make a company successful, like a compounding machine? It's a great question. It's really just about experience. It's about understanding the business, reading what other great investors, how they see the business, reading the annual reports, studying the CEO, the management team. Really just the more you understand a business and the ecosystem that it's operating in, the more those couple things that matter are gonna jump out at you. One of the things I really like about watching Aswath Damadran's videos, how he values companies, he's very skilled at identifying what are the couple things, what are the 3 or 4 factors that are going to move the needle on value, on valuation for a business over the next decade, right? And he makes those 3 or 4 things kind of the cornerstones of his valuation. So, just looking at businesses through the eyes of great investors, through Value Investors Club, through Corner of Berkshire and Fairfax. There's a ton of different places. MOI, Global. Manual of Ideas is a great source for getting investment thesis, investment pitches, learning to see businesses in that way, through the eyes of a business person, through the eyes of a great investor. There's no shortcuts there. If Apple would make cars, would it still have windows? I giggled, I must say, Stefan, when I first read that. That is a great question. And I'm a dad. That's an awesome dad joke. I might have to tell my kids that one. Probably not now. They're probably too young for that, but I'm going to keep that one in my back pocket. Any advice on how to grow a YouTube channel? I wish I could have your growth. Make a video every day. The best way to do that is to forget about editing. Okay? Just hit record. You're going to make mistakes. You're going to feel like a goof on a number of occasions. That's okay. Just make sure you're putting out a video every day. The great thing is, in the early stages of your YouTube channel, nobody's going to be watching. Okay? So you're going to make all kinds of mistakes, but it doesn't matter because nobody's going to be watching. As you get better from practice, from making a video every day, your videos are going to be higher quality, right? Your content is going to be higher quality. And that's going to coincide nicely with your viewership count rising. Okay, so it's kind of a beautiful, parallel there. So that's all I would say. First of all, decide what topic are you excited to talk about every day. That's step 1. Step 2, commit to putting out a video every day. And, stretch yourself. Try to make it 10 minutes or even more, all right? And, just keep going. Keep going. That's the best advice I have on that. That's what I've done. That's exactly my roadmap for that. Huge fan. Awesome. Thank you. What would you be looking for to invest in a very early stage company like Topicus, for example, that is still losing money? At which point would you feel safe to pull the trigger and capture a long runway? So when it comes to early stage companies where you don't have much of a financial history to look at, you can't really, sink your teeth into anything quantitative. For me, it's really a bet on the jockey. All right, what is the track record of the management team, the CEO in particular? And I haven't done a lot of this, but I'm starting to open up to these kinds of opportunities, very early stage companies. So yeah, getting comfortable with the jockey, right? The capital allocator. That's what I'm looking for. If you had to start today all over again with the allocation of capital and building a portfolio, how would you proceed and how would you pick your stocks? In consideration that a lot of the companies are richly valued and choices are few and far between. Any tips on starting a value-oriented portfolio? I was thinking of dividing my portfolio in two halves, one being value-oriented long-term compounders and the other index fund, monthly averaging, buy and forget. Any thoughts on that? I think that's a great idea, actually. This is Warren Buffett's advice to the majority of investors is index, right? Set it and forget it. Have a set amount each month or each quarter or each week, however often it is, going into index funds. I think there's a lot to be said for that, particularly for the people who don't want to put in the work of studying great investors and learning about individual businesses. So that's a great tip. If I were starting over again today, I don't think I'd do it a lot differently. I would identify, say, 5 to 10 great investors, and I would just look at what they're buying each quarter through 13F filings and maybe swing a couple times a year when it's kind of obvious, when something comes along that's obvious, that's kind of near or even below the buy-in price that great investor had, with a business that I could understand, I could wrap my head around. There aren't too many secrets there. But yeah, I don't have a problem with this two-pronged approach. And this came up earlier. The reason I don't have a problem with this two-pronged approach is one of the prongs here, it doesn't require any work, right? It doesn't require any thinking. A little upfront, right? It's like, what index funds do you want to be investing in? But other than that, it's automatic. And I really value this idea of having the investment portfolio automated. I think there's a ton of value in that. So I think it's a smart approach. Is there something that shows forward PE for more than the 1 year ahead? Some analysts would obviously forecast more than 12 months of forward earnings. I'd be very hesitant to rely on analysts for these estimates beyond a year, even for the next year. I think it's really important to kind of follow your own thinking when it comes to, all right, what does it look like for the next year, the next 5 years, the next 10 years for any particular business that you're considering investing in. You got to realize these analysts, they're not putting their money behind these bets most of the time, okay? So you got to understand what's driving them to, ascribe certain forecasts to whatever companies that they're following, whatever companies they're covering. Their interests probably aren't aligned with yours, right? They're employees. They're getting paid to write these forecasts. So it's really important to do your own thinking, is what I would say about that. So no, I don't think there's any value to if there are, right? And there are, analysts often give 5-year forecasts. But I don't put any weight on those, and I don't think others should either. I think Warren Buffett and Charlie Munger would say the same thing. What questions would you ask to a management team of a business you've invested in? So quite frankly, I wouldn't be talking to a management team, okay? And the reason for that is management teams have gotten to where they are because they are, very charismatic, okay? They're great at, they're incredible social creatures, right? They know how to persuade people. And I don't want to be persuaded as an investor. I want to remain rational when it comes to, investment opportunities. So if I'm talking to a management team, of course, they're going to share all of the rosy things about their business. And I don't want to be influenced by those things, quite frankly. And I think that's true for a lot of, value investors, why they don't talk to management teams. So I wouldn't be asking questions to a management team. How would you react if your stocks portfolio dropped 50%? That's a great question. It's never happened to me, fortunately. Trying to think if there are any companies, individual businesses that I've owned that have dropped 50%. I think GrafTech might have dropped 50%. And that was tough. That was very tough. If my entire portfolio dropped 50%, it's hard to say. I mean, it's one thing to rationally think, well, I own businesses, right? And so I would look at the underlying businesses and ask myself, is the business 50% worse today than it was when I bought it? And by and large, the answer to that would be no, right? It's just the manic depressive Mr. Market overreacting. But it is tough. And the only way you really know how you react with a swing like that is to experience it. So because I haven't gone through a whole portfolio drop of 50%, I don't know. I'd like to think that I would remain rational, remain focused on the businesses in my portfolio, rather than looking to Mr. Market as if it had some sort of wisdom that the companies I'm investing in were a bad decision as reflected by the price move. So yeah, I'd like to think it wouldn't impact me too much. But again, that remains to be seen. Wondering how you manage life, investing, and work together. Have you a full-time job besides YouTube, and is this something which helps in getting a better investor? I think this has helped me a lot. Just running this YouTube channel, become a better investor. It's one thing to think you know something. It's a completely different thing to teach it, right? To teach what you think you know, and get feedback from people all over the world who are also interested in investing. It's been just a fantastic experience. I get so much value out of the comments in each and every one of my videos. YouTube is not my full-time job. I work in permaculture, kind of edible landscaping, food forests, sustainability. But I do see more and more of my income coming from investing. So, and I am working towards that. I'd like to have an income that's not dependent on where I live, something I could do from anywhere. And my sense is that that's kind of what I'm building here on YouTube. And, I'm sure it will go beyond YouTube at some point. I have no idea, what will come next. But YouTube, it opens up a ton of opportunities, just all these connections that I'm making with people all over the world. So it's very exciting stuff. The opportunities are endless. So yeah, for anyone who wants to be a better investor, I would highly recommend it to teach to others what you're learning about investing. It's just incredibly helpful. Which stocks are you actively tracking? So funny you should ask. So this is something I'm sure I'll share more about soon. But this is kind of the short list of companies that I'm currently digging into. There's 7 companies on this list. They're all kind of less than $1 billion-ish market cap. Green Brick is a little over $1 billion. But these are the ones I'm digging into. I'm sure I'll share more about these in the coming weeks. But yeah, the first step is really just putting up some of the metrics that are more important to me, insider ownership, gurus, value investors club, and then who else, understands these businesses. And some of the ways I'm looking at that is who has done talks or presentations through MOI on these businesses. Are there threads on Corner of Berkshire and Fairfax? Who on Twitter has shared information about these companies? So, all these different platforms, who can I kind of bounce, information, ideas off of, questions related to these companies to really make sure that I understand them. So this is kind of where I'm at right now. And a lot of these have come up through Twitter or following other kind of small investors. You got Mike Mitchell, FG Financial. AltaFox Capital, of course, put out VIQ Solutions not too long ago. DLHC came up from looking at 10 baggers over the last 10 years, doing a screen in Value Line, and seeing, this has been a 10 bagger over 10 years and it's still very small, right? 132 million market cap. So digging into that one. GTT came out of searching for which companies had gotten pummeled the most in the last 5 years. This is something I picked up from Sir John Templeton, from Richer, Wiser, Happier. And I found out Greg Alexander owns GTT Communications. I think he owns like 8% of the shares outstanding. And they've dropped a lot. So I'm trying to dig into, did they drop too much? Did they drop below what the actual value of the business is? Or is this in fact a business that's just heading towards bankruptcy? That's kind of what I need to parse out there. So anyway, guys, these are some of the companies I'm digging into. Let me know in the comments if you have also dug into any of these and what you've learned about them. Help me kind of expand my knowledge about these companies would be awesome. There's a few links here for a couple of these, where to find more info. So thanks for that question. Do you use any mobile app for tracking company financial statements like Ticker app, etc.? I don't use anything like that. I do it more the old-fashioned way, just through the SEC.gov website. I should probably get a little bit better about this, kind of set up some alerts, but I haven't done that yet. Have you added anything new to your wish list from the latest round of 13Fs? Not to my wish list, I would say. Coupang is kind of interesting, kind of the Amazon of South Korea. I would say that's kind of the most interesting company to come out of the latest round of 13Fs, but nothing that I would say I've added to my wish list. What do you think about barbell strategy? Yeah, I'm not too familiar with barbell strategy, and options isn't something I've really gotten into. I think what Pabrai would say about that is, some of that is, are you in a hurry to get rich? And, I'd say the way that Phil Town does options probably isn't so much being in a hurry to get rich. It's more of an intelligent way to, selling puts, for example, something Phil Town does quite often, and also Matthew Peterson, who I've been listening to. He did a lot of work on Daily Journal Corporation, valuing that company. It's really just not something I've spent too much time on, and I think part of it goes back to focus, right? If you stretch yourself in terms of doing all this research on individual businesses to try to find the ones that are the compelling long-term compounders, and then you throw options strategies on top of that. At some point, you're kind of diluting the focus, and perhaps sacrificing returns. Even if rationally you might think, well, if I have more tools, right, I can go long these companies, I can do all these kinds of options strategies. Certainly that's going to improve my overall result, but I'm not 100% convinced of that, because again, we only have so much time in the day, and I'm at this point I'm more focused on, solely focused on what are the businesses that I want to own for a decade or more, and just go long, right? Nothing fancy, keep it simple. Thoughts on cerritage? Yeah, I don't really have any updated thoughts on cerritage. I like what Pabrai has said recently on cerritage as being in the funeral services business. And what that means, it's a metaphor, right? They're not literally in the funeral services business. They're taking these old Sears stores that, don't really have any use. Sears is done, right? Sears is kind of out of the picture. But taking these boxes, right, these old retail stores, and giving them new life, developing them into something that's kind of the best use case for each location that these boxes are in, bringing them back to life in a sense. That's the business that cerritage is in. But in terms of, my investment thesis on cerritage or any of that, none of that has changed. I think it's going to take a while to play out, probably at least 5 years, perhaps more like 10 years. So it's really just something I'm, buy and forget for a decade, and I'm comfortable with that. Why do most investors assume that the guru got it wrong when the investment decision does not make sense to them? That's a great question. Would you assume the same in chess with Kasparov as your helping hand? Yeah, I think we're all kind of innately biased towards what we can understand, right, and can't understand. And there's ego in that, right? If we can't understand it, it's compelling to just say, well, this person doesn't know what they're doing, rather than owning up to the fact that, well, I don't understand it, okay? It's outside my understanding. And I think that's where investors really get into trouble. Charlie Munger talks about this. The dangerous thing when it comes to investing is thinking you know something when you really don't know, okay? And Li Lu talks about this as well. So I think it's really important, super important, to know what you don't know and not let your ego get in the way of being rational on what you know and what you don't know. And I think it is mostly ego. And it's also why cloning is so powerful, right? Because, these gurus, these super investors that have been in the game for decades, they have such, radically more nuanced mental lattice work than we do as younger investors. That doesn't mean they don't, wander astray, right? That doesn't mean they don't make mistakes. But I think most investors underappreciate just how powerful their thinking is, backed by decades of experience in investing. So, I think it's an important question to ask yourself. Thanks, Robin. What's your long-term goal for your investment portfolio? Pass on to your kids, lavish retirement. Do you have a specific number in mind to reach that goal? I'm a little embarrassed to say I don't have a long-term goal, but I'm also not fully embarrassed, and here's why. This is really just fun for me. Okay, it's a game. It's a game I think I can win, and the game is, see how much I can juice this compound growth engine, right? That is my investment portfolio and my learning, my thinking in terms of investing. So it's not really at all about a destination. It's about enjoying the process and stretching and growing and, developing my clarity of thought when it comes to investing. So passing on to my kids, that's not really something that's a big part of this game for me. I think it's probably a disservice, as Pabrai has said many times recently, to pass on a big inheritance to the family. But it's a game I'm really enjoying. This investing, this compounding capital over time. That's all I'll say about that, Mike. What do you think about buying in the money leaps as a strategy to leverage up on a very high conviction bet? Leaps are interesting to me. I did some research on leaps a couple of years ago, and I've been re-inspired about leaps because Tobias Carlisle mentioned leaps as a strategy on Investing with Tom on his YouTube channel. They did a kind of a collaboration on there, and Tobias did a video with I think it was a podcast with Matthew Peterson talking quite a bit about leaps as a strategy. I think it was within the last year, definitely within the last 2 years, and I want to listen to that again and really understand better how to value leaps, right? How to value these options. Of course, I just talked about how, I'm only going to focus on going long, and options kind of detract away from focus. Yeah, it's a bit of a contradiction to say, I'm looking into leaps a little bit. But leaps can also be a tool for entering into a position in a portfolio. So I don't know. I'm kind of mixed. On, do I put energy there? Is it just detracting from kind of the core of identifying these great long-term compounders? I don't know. I'm not sure yet, but I am dabbling a little bit into learning about leaps as a strategy. So also Joel Greenblatt in the Yellow Book, right? How to be a stock market genius, something like that. He talks a little bit about leaps in there. So check that out if you're interested. Can you kindly help me understand how Nick gets old stores using 40% of the asset base? Old stores. I'm not sure about this one. I don't know that I have. Okay, I think this is trying to value Costco. Yeah, this is a Nick Sleep's framework for how he's looking at the Costco investment thesis. I'm not going to get into this one now. But I think the best way to understand this is to just read it through a couple times in the Nomad Partnership letters, and spend a little time thinking about it. And I think it should make sense. It took me a few times reading it as well to really piece together how he was thinking about Costco. What is the difference between the reporting date and the filing date on 13F filings? So the reporting date, I believe, is just the last day of the quarter that 13F covers. Okay, so for example, in Q1 2021, the reporting date would be March 31st of 2021. That's kind of the prices that are listed. Those are from, the close of market on the last day of that quarter. The filing date is, whenever that 13F is filed. And 13Fs have to be filed within, I think it's 45 days of the quarter that they represent. So for example, Q1 2021, Typically, the 13Fs have to be filed by like May 15th or something like that. So that would be the filing date. Hopefully that answers your question. Do you think Pabrai, Munger, Alexander, Lilu are buying more Alibaba as the price has been falling further after the 13F? I don't know. I have no real way to gauge that. I think Pabrai put on a pretty full position in Alibaba. I know he likes to make 10% bets. And it was close to that. I think it was like 9% or something like that. So, but I really don't know. Yeah, we'll just have to wait and see for the next 13Fs, which come out middle of August. So I'm excited to see those, of course. Monish has talked about his own position sizing philosophy and has stopped suggesting Kelly formula. Absolutely. Do you know how does Warren, Munger, Lilu size their positions when they find an opportunity? By what framework or thinking would these super investors sit on piles of cash instead of adding to their positions? I think there's a lot that goes into this, and it's really opportunity cost, right? So, what are all of the opportunities that are in front of them, and how do they allocate capital given the opportunity set in front of them, and of course with allocation considerations as well. I don't think Pabrai ever used the Kelly formula for position sizing. It was more theoretical when he wrote that in his book, because again, it doesn't really apply, Kelly formula, to concentrated value investing where you can only make a certain number of bets. Kelly formula is when you know the odds and you can make repeated bets over and over again. But I don't know how these investors specifically decide. I don't think they have a formulaic approach when it comes to making position sizing decisions. I think it's more complex given, like I said, the opportunities that are available to them at the time and how much cash they want to have. Berkshire Hathaway, for example, given, what are the risks in the market? Obviously there's a lot of insurance exposure with Berkshire Hathaway. So, having a bigger cash pile is going to be important potentially when these unusual events come about, like the pandemic that we saw last March 2020. So again, I think it's a dynamic framework. My question for you, why do you entertain the magic formula? Would this not seem to go against the philosophy of value investing? And I do need to dig into this a little bit from the Intelligent Investor. It is commentary, so my sense is it's not from Benjamin Graham. It's kind of in one of these updated editions, whoever the contributors were to the commentary on the updated editions. Mechanical formulas for earning higher stock performance are a kind of self-destructive process akin to the law of diminishing returns. So here's why I entertain the magic formula. I have some sense that, sticking to the magic formula over 5-10 years can produce outperformance. And I want to test that. If it's the case that I can generate better investment returns following, I'm doing kind of a modified magic formula where I'm applying a number of filters to the magic formula. If that does better than me, doing these concentrated portfolio bets, I'm just going to do the magic formula, okay? Because again, this game is about how can I compound at the highest rate. It's not, how do I actively become the best investor that I can possibly be by identifying individual businesses better than other investors can. So it's really about testing, okay? I want to test the magic formula. I want to see how well it works, given the framework that I've applied to it. So we'll see. Maybe it doesn't work, okay? But at least then I know that, my approach to magic formula didn't produce the returns that I wanted it to, and I would have done better just indexing or doing some kind of cloner approach. I want to know that. And the only way for me to know that is by testing it, okay, with real world data. So that's what I'm doing there. Do you copy the free lunch portfolio? I do not copy the free lunch portfolio. The only kind of automated approach I have going right now is the magic formula. And I've made videos about that. Kind of each quarter, I think I've made 3 or 4 videos about that in the past. I have another one coming up at the end of June, so keep an eye out for that. But I can't copy every strategy that seems compelling. It's a lot of work, and given what I knew about the magic formula at the time, about 9 months ago when I started, I think maybe more like 11 months ago, it seemed compelling. All right, so I was just like, okay, let's go with this one. It seemed more compelling than the free lunch portfolio, to be quite honest. And the free lunch portfolio has changed quite a bit. It's not sort of a automated kind of set mechanical approach. There's a lot of, Pabrai has a lot of, he has a lot of say in how that portfolio is constructed. It's not based on preset rules. And we've seen that recently because he's been kind of changing, the different buckets, right? Originally it was spin-offs, cloners, and Uber cannibals. And now instead of spin-offs, it's spawners. So it's this dynamic, evolving thing, which is tough in terms of testing whether an approach works, okay, to have this evolving strategy. It's not something you can really test over time, okay, because it's changing, right? The variables are changing. So that's one of the reasons why I don't copy the free lunch portfolio, but I do look at it each year as a potential source of companies to dig into. So thanks for that question. When are you getting on TikTok? I don't have any plans to get on TikTok. I think the type of content around investing that's produced on TikTok would kind of drive me crazy. I think I would be very alone as a value investor on TikTok in this sea of speculation from all these youngsters who haven't been through past crashes, right? They've only kind of experienced this euphoria of the last couple of years in a rising market. So yeah, I'm not super drawn to TikTok, but give me some reasons why I should be on TikTok if you guys want to see me create a presence over there. Last question, what's your take on buying long dated puts on QQQ and or TLT as Burry did for generating income as inflation is rising? This isn't really an area that I have any particular knowledge about. Again, reach out to Karan, poke him to do a video on this, because I know it intrigued him what Burry did with the TLT. So that's my best advice for that. Anyway, guys, this was awesome. There were so many interesting questions in this Q&A. Keep it coming. I'm going to keep this going every week, even when the rest of my content kind of drops off. These Q&As are going to be a staple of this channel for months and hopefully years to come. So thank you all for putting in the energy to these questions. Really kind of motivates me to dig in and give you guys my best stab at answers to these questions. So without further ado, thank you all, and I will see you in the next video. Take care.